I'm not promising gold's going to the moon tomorrow. And if it goes to $10,000 an ounce, bad stuff is happening. And I kind of don't want that to happen. It means, you know, scary stuff is going on in the real world. But I do see a lot less downside. I'm not afraid of gold having gone too high too fast, and now it's going to be down for the next, whatever years, like in 2011 and 12. I don't think that's the situation at all. We've gone through a game-changing situation with the central banks around the world really getting the memo and piling into gold. I think not just that, the political risk around the world has got deep pockets around the world buying gold as well.
Gold prices rebounded from a one-week low near 3,309 on Thursday after Federal Reserve Governor Christopher Waller signaled support for a rate cut in July. Waller noted that mounting risks to the U.S. economy justify monetary easing, reinforcing market expectations that the Fed will begin reducing rates by the end of the month. Lobo Tiggre, a respected voice in the metals and mining space, highlights the 3,300 range as a strong support level for gold. While he's not calling for a rapid surge, he cautions that if gold ever climbs to 10,000, it would likely reflect major turmoil in global markets. For now, Tiggre sees little downside risk, supported by solid fundamentals and growing interest from institutional investors. Demand for physical gold bars and ETFs remains resilient, even as spreads have narrowed, signaling improved market liquidity and sustained investor engagement. ETF flows have held steady despite recent price dips, with large institutions increasing allocations to gold as a hedge against inflation and fiscal uncertainty. According to Tiggre, the global financial landscape has shifted. Central banks now fully grasp gold's role as a reserve asset, and major institutions are following suit. It's not just fringe preppers anymore, he says. Big money understands the risks. Meanwhile, mining stocks are lagging behind the broader move in gold. Even though the GLD ETF closed higher recently, the GDXJ, a junior gold miners ETF, ended the session lower. Tiggre sees this divergence as an opportunity. While gold trades near record highs, miners remain undervalued, particularly when priced in gold terms. That's where he believes real upside potential lies. In the mining equities, not just the metal itself. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I remain very bullish. I mean, after hitting an all-time high of 3,500, I put that in air quotes, but actually, if you adjust by CPI, that matches the 1980 peak. And so for gold to bounce off that and come back again, I do think that's significant. I'm not a TA, but a lot of people are, and they may invest accordingly. So, for all the fundamental reasons about gold being real money, what's happening with fiat, I'm very bullish on gold. I don't think this is the end of the story, but something like that, bouncing off a long-term high like that, that does make me cautious about just saying, buy, it can only go higher, right? That having been said, I do think the central bank gold buying is an absolute game changer. We see gold holding up to news that in previous years would have set it back. Powell did this or said that, or, he scratched his ear a little bit this way, and therefore, the whole market's going to blow up or what, right? These things that would have not gold back before are not. I mean, we've gone all the way down to 3,300, which seems to be holding pretty well as a support level. I think this is very significant. So what I'm saying is, dear audience, I'm not promising gold's going to the moon tomorrow. And if it goes to $10,000 an ounce, bad stuff is happening. And I kind of don't want that to happen. It means, scary stuff is going on in the real world. But I do see a lot less downside. I'm not afraid of gold having gone too high too fast, and now it's going to be down for the next whatever years, like in 2011 and 12. I don't think that's the situation at all. We've gone through a game-changing situation with the central banks around the world really getting the memo and piling into gold. I think not just that, the political risk around the world has got deep pockets around the world buying gold as well. Our friend Jeffrey Gundlach said it's not just for lunatic survivalists anymore. It's a real asset now. So yeah, I do think that's different. So not promising the moon, but I see limited downside. If I didn't have exposure to gold, I absolutely would now. And the good news, and I'll shut up about this, is that while gold itself has hit this high, the gold stocks, especially priced in gold, which is the more realistic way to look at them, many of them are still compelling value propositions. There are real investment opportunities speculating in gold stocks, I think, still on the table. I have been bullish on silver. There's a perception out there that I'm a bear somehow because I've said some mean, nasty things about silver's industrial side, but I am bullish. If you think about it, Peter, if I'm bullish on copper and I'm bullish on gold,
Yeah,
how can I not be bullish on silver, right?
absolutely.
So I'm bullish. I won't beat that to death. I do think the industrial side is reason to be cautious about this latest breakout. Everybody's all excited. Woohoo, silver went to 39. It's off to 50 now or higher. But if you think about it, that happened when gold wasn't moving. So I don't think that happened because of the monetary. It's got nothing to do with the dollar, de-dollarization, BRICS, any of that stuff. It's the industrial side. And if you think about it, you haven't asked about platinum, but that's up more than anybody else this year amongst the metals, 54% last I saw. The day that silver went to $39 for the first time, palladium moved even more on a percentage gain basis that same day. So not making a bear case. I'm just saying it looks to me like there's something happening on the industrial side that's moving these silvery industrial metals. It's giving silver a tailwind too. That is at risk under Trump shock. As the real impact of the changes move through the economy, that headwind could near term turn into a tailwind. But farther ahead, all paths lead to inflation. This is great for monetary metals and the agenda, the reindustrialization, remilitarization of Europe, Chinese stimulus, all this stuff going on around the world is very bullish for commodities as a class. And silver, all those people got their rotten tomatoes to throw at Darth Silver for saying mean things about silver. Listen to me now. Silver benefits from the monetary metal side of that inflation and from the whole commodities super cycle as an essential, critical industrial mineral as well. So I see silver actually in due course as the win-win metal in a way that I don't see gold.
The M2 money supply climbed to a record 21.94 trillion by the end of May, surpassing its previous peak of 21.72 trillion set in March 2022, according to data from Barchart. The year-on-year growth rate held steady at 4.5%, matching April's figure and marking the highest pace in nearly 3 years, as reported by Yahoo Finance. Lobo Tiggre points out that despite ongoing rate hike narratives, the system remains awash with liquidity. There's still tons of money being pumped into the system, he says. Washington keeps spending like crazy, fiscal dominance, as Lynn Alden calls it. Trillions in spending with vague promises to rein it in later. Tiggre adds that this isn't unfamiliar territory. Following the 2008 financial crisis, massive bailouts injected capital directly into Wall Street, fueling asset price inflation. Today's market strength, he suggests, may not be a case of irrational exuberance, but rather a rational response to a flood of liquidity. That money needs to find a home, and often it lands in financial markets, real estate, or hard assets like gold and silver. Historically, surges in M2 have had a lagged impact on inflation, particularly the Fed's preferred metric, personal consumption expenditures. According to a blog post by the St. Louis Federal Reserve, the PCE inflation index began rising in February 2021, roughly a year after M2 growth soared in early 2020, and trended lower in 2023 as M2 expansion slowed. Let's get back to the interview.
Even if you wear a MAGA hat, you completely agree with everything Trump is doing. What he's doing is transformational to reindustrialize the United States, but not, to go back to the 1950s and 60s, but to put it in a modern, 21st century industrial footing, which has a lot to do with military strength and keeping America on top. I like to say it's not just America first, it's Fortress America first. To me, that encapsulates the Trump agenda. Now, obviously, Trump fans love this. Other people maybe not so much. Doesn't matter whether we like it or not. This is huge. It is transformational. Whether it works or not, the attempt is huge, and it will have repercussions. I don't think there's any way that this can be done without pain. The very least, growing pains, teething pains, whatever you want to call it. Don't let your fascination with the White House blind you to the costs of making the changes that are underfoot. And of course, if you're a Trump critic, you don't need me to tell you that Trump shock is still a thing. I just think this is really important. I think mainstream investors are far too sanguine on what's coming down the pike. There's this feeling that, peak Trump shock is behind us because April 2nd wasn't so scary after all. that was just the initial salvo. And the tariffs that we're actually seeing now agreed to are close to, and in some cases higher than what was announced on April 2nd. And yet equities are higher now than then, even after this big sell-off. So you could say, oh, Mr. Market's crazy, just doesn't understand. I don't think that's entirely true. I think there's also what our friend Lynn Alden likes to call fiscal dominance, the big, beautiful bill, trillions of dollars in spending. Don't worry, we'll cut the budget later. This also trickles down to Wall Street. We saw that in spades in 2008. Where did all that money go? It went to Wall Street. So with all that money sloshing around, maybe Mr. Market is not crazy for chasing stocks. All that money has to go somewhere. But that doesn't mean the real world won't feel the impact of what is being attempted right now, which I think is truly historic. I think Trump shock, even if you like it, even if you agree with the agenda, it's of an order of magnitude as Nixon shock. This is a game changer. So don't be complacent. I think this is definitely not a time for, passive investing in ETFs. And there maybe I am patting myself a little bit on the back, Peter, because I am a stock picker. And I do think the audience would be served well by being in my camp rather than the passive camp. That's my overall view. Of course, you want to talk metals and mining, and I'm happy to do that. But I just think this is really important. I think a lot of people don't get how big a deal this is. And especially if you think the worst of it is behind us, I think that's something that could lead to unhappy investment outcomes. I'm not convinced the tariffs stick on the one hand, because they are very high, and the U.S. imports half of its copper. And copper is like gasoline or oil. It's essential. It's Dr. Copper, an essential economic indicator, because you need copper for everything. On the other paw, that's why we tax gasoline, because everybody's got to have it. So if you're the government and you want your pound of flesh, there's no evading a gas tax. It's collected right there at the pump, whether you want to or not. So copper is kind of like that. If the reason for the tariff, Peter, is revenue rather than, or in addition to trying to incent domestic production and all that other stuff, then they may not go away. Because think about it. Where do we get copper? Chile, Peru, Indonesia. Trump was just talking about beautiful Indonesian copper, which is some of the best in the world, even though copper is an element, once purified, Peruvian copper is the same as Indonesian copper or any other copper, but we don't get it from China or Russia or somebody we're in opposition to. So, does Trump really need to beat up Peruvians over the copper price? I don't think so. I don't see statecraft as the real reason here. And as far as motivating production domestically, okay, fine.
Despite headlines dominated by interest rate speculation, a deeper undercurrent is shaping the trajectory of gold. Relentless monetary expansion and a silent but steady repositioning of capital. Liquidity levels are surging back to historical highs, not through organic growth, but through sustained fiscal overshoot and political inertia. As capital sloshes across the system, institutions are recalibrating, diverting flows toward enduring stores of value. While gold continues to hold firm near its support levels, the disconnect between its price and the underperformance of miners may hint at overlooked leverage in the sector. Markets are no longer responding to policy signals. They're reacting to systemic conditions. Will this growing divide between liquidity-fueled valuations and grounded assets like gold eventually spark a broad repricing across the financial landscape? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.